Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, about that time, the fact checkers came after me. Turns out, I was right. Now, I don't often engage in "I told you so." Well, that's not altogether true. I engage in it a lot in my head. I don't often engage in "I told you so" out loud. But hey, I did tell you so. And I'm talking about an appearance that I did on RT back in 2019. For those not familiar, RT is a state-run Russian media outlet. It was pretty prominent before the invasion of Russia. And I think that prominence basically just stemmed from the fact that it did provide kind of an alternative to the mainstream American media. Take that as you will. Now, if you come at me for being a Russian agent because I went on RT, I'm going to mock you relentlessly. They offered me an opportunity to talk about something that I believed was true. And truth is truth, right? It doesn't matter what platform that truth is disseminated on. And let's be honest, very few people in mainstream American media were willing to discuss it. And as I said, I was right. So what was I talking about? Well, I was talking about the weaponization of the dollar. And on the show, I explained how the U.S. used the greenback as a foreign policy tool. And I warned that if the West wanted to, it could and probably would use the SWIFT payment system as a foreign policy hammer. And, we can debate whether that's good or bad foreign policy, but it does have ramifications. So what is SWIFT? Well, it is an acronym. It stands for the Society of Worldwide Interbank Financial Telecommunication. And basically, it's just the system that serves as the global economy's superhighway. Let's put it that way. In practice, it is the global financial messaging service that facilitates cross-border payments. And the SWIFT website puts it this way: SWIFT is the way the world moves value. Now, since the dollar serves as the world reserved currency, SWIFT effectively facilitates the international dollar system. Global trade is done in dollars, and SWIFT is the mechanism by which that trade is done. And even before Russia invaded Ukraine, the West and the U.S. had used SWIFT as a leverage point. For instance, in 2014, the Obama administration locked several Russian financial institution out of SWIFT as relations between the two countries deteriorated over Ukraine and Crimea. And then a few years later, the Trump administration threatened China in an attempt to force that country to join in sanctioning North Korea. And this is exactly what U.S. Treasury Secretary Steven Mnuchin said at the time. If China doesn't follow these sanctions, we will put additional sanctions on them and prevent them from accessing the U.S. and international dollar system. So what I was talking about, a U.S. Treasury Secretary had publicly threatened, and yet I got fact-checked. The fact-checker was the Voice of America. And I have to note that if you want to criticize RT as a Russian propaganda outfit, and that's probably fair, the same can be said of Voice of America. In its mission statement, it says VOA is part of the U.S. Agency for Global Media, the government agency that oversees all non-military U.S. international broadcasting. In other words, propaganda. Anyway, that's neither here nor there. Regardless, the fact check was, I gotta say, pretty lame. The headline of this fact check was, RT falsely claims U.S. uses SWIFT as a weapon. Well, the headline's already wrong because I just read to you what Mnuchin said when when Trump was president. It said that I was misleading because SWIFT, quote, is not an American organization. Side note, I never said it was, but it is a Western organization and it is dominated by the United States. And regardless, we all know that as the world superpower, the U.S. gets its way. We can get pedantic about who owns what, but the fact remains that SWIFT is a tool of the West, which is led by the U.S. And most importantly, as I said, I was right. For all of VOA's efforts to convince us that SWIFT would never be used as a foreign policy billy club, that's exactly what happened when Russia invaded Ukraine. The West locked Russia out of SWIFT, along with all of its other sanctions. And, the U.S. even threatened to take things further than that. Last year, Treasury Secretary Janet Yellen floated the idea of liquidating frozen Russian assets and using them to rebuild Ukraine. Basically just taking things that were owned by Russia and selling them, giving them away. Now, I'm not interested in debating foreign policy. I'm not saying Russia was right to invade Ukraine. I'm not even saying necessarily that this foreign policy is bad. It is reasonable to argue that Russia deserves to be sanctioned and that it was the right move. But it's also important to recognize the potential blowback of any policy. And there was certainly blowback to the way the U.S. and the West handled sanctions. It has hastened de-dollarization. And that is a significant vulnerability for the United States that I don't think the U.S. really takes into consideration as much as it should. Now, when you say something like de-dollarization, well, what is that? It's exactly what it sounds like. It is the process of other countries reducing exposure and dependence on the U.S. dollar. Now, I know it kind of sounds like some kind of conspiracy theory thing, but it is happening. And it sped up significantly after the economic moves that the West made against Russia. And, even the Associated Press recognized the risk of dollar weaponization when Yellen started talking about selling Russian dollar assets. Now, that was certainly an extreme kind of move, but like I said, even the AP got it. Here's what they said. There are trade-offs since the weaponization of global finance could harm the U.S. dollar's standing as the world's dominant currency. It's a fact. And I would argue that's exactly what happened. It makes sense, right? Think about it. If you recognize that there's something out there that makes you vulnerable, you see something and it's creating a vulnerability in your life or your finances or whatever, what are you going to do? Well, if you're smart, you're going to take steps to try to eliminate or at least minimize that vulnerability, right? You're going to separate yourself from that thing that is risky. So if you are worried that the U.S. and its allies might cut off your access to dollars, what are you going to do? You're going to minimize your dependence on dollars, right? In other words, if you are concerned that the U.S. could pull the dollar rug out from under you, why not pull out from the dollar system first? Get off the rug. A year ago, Aberdeen Standard Investments Director of Investment Strategy, Bob Minter, said he believes we are seeing a strategic pivot away from the U.S. dollar amid geopolitical tensions. Exactly what I was talking about. He pointed out that many emerging market countries are diversifying their reserves to minimize their dependence on dollars and ostensibly minimize U.S. control over their foreign policy. And then he went on and he pointed out that all four presidents have used the dollar's reserve status as a means or an arm of U.S. foreign policy. And he was referring, of course, to George W. Bush, Barack Obama, Donald Trump, and Joe Biden. He went on, he said, if I were in charge of an emerging market country's foreign currency reserves, I would want to diversify away from the dollar. You harden your currency with gold. And this is almost certainly one of the underlying reasons so many central banks are buying gold. We'll get to that here in just a moment. Now, I've heard some people in our circles warn that this could end up with a total collapse of the dollar. or a complete fall off of its perch as the world reserve currency. And honestly, I think that's a little bit overstated. I don't see a quick collapse of the dollar coming down the pipe. The dollar still has way too much clout in the global financial system for it to just collapse. Now, I think there are countries out there who would be more than happy if it did collapse, but they also recognize that it would have ramifications for their own economies. So, the dollar is so intertwined in the global economy that you can't just yank it out. But that doesn't mean there isn't a problem. I see it more as a slow bleed, a gradual decline, kind of like my goalie skills as I get older. I can still play the game, but not nearly as well as I could 20 years ago. And 10 years from now, it'll be that much worse. And at some point, I probably won't be able to play at all, right? That's kind of how I see the future of the dollar. And it's important to keep in mind that every fiat currency, no matter how strong it might be at some point, has a shelf life. Every fiat currency has collapsed, empires fall, world dominances fade. That's just the reality. And, here's the thing. It doesn't really matter whether it happens slowly or if it happens all at one time. An end to the dollar's status as the world's reserve currency would mean disaster for the U.S. economy. And by an end, I mean even having to share it with another currency or gold. The United States depends on global demand for dollars to facilitate its borrowing and spending. The greenback's status helps support America's economic and military dominance. And, as I said, a complete collapse of dollar dominance seems kind of unlikely. However, an equally problematic scenario remains very much within the realm of possibility, and that is an evolution to what is being called a multipolar world. So the dollar is still prominent, but it plays a much less dominant role in the global system. It has to share its status with other currencies. In a multipolar world, several currencies would play a significant role in the financial system. Dollars, of course, would still be important, like I said, but the role of the greenback would diminish as other currencies, including, say, the euro or the yuan, they gain more influence. And a multipolar world would also drive a diversification of global reserves, with gold and other currencies making up a large percentage of those holdings. And we're already seeing this trend developed. I mentioned central bank gold buying. Just how much gold have central banks bought? Well, over the last 3 years, they've added over 1,000 tons of gold to their reserves in each of those last 3 years. And to kind of put that into some perspective, central bank gold reserves increased by an average of about 473 tons per year between 2010 and 2021. So the pace of gold buying has doubled, basically. And meanwhile, at the same time, the percentage of dollars that are being held by central banks, it's dipped by 14% since 2002. And again, that drop in the share of dollars as global reserves has sped up since we've seen this very aggressive weaponization of the dollar. There was another example recently in the news that kind of underscores the lessening appeal of the dollar, shall we say. And that is from the National Bank of Kazakhstan, short NBK. And it recently announced plans to sell dollars to ease the inflationary pressure caused by its gold purchasing program. So the Kazakh central bank buys most of its gold from domestic production, and it holds a lot of gold. About half of its reserves are in gold. And so it can actually just go and buy in the domestic market without having to engage in the world gold market. And it's worked. This program has increased official Kazakh reserves to $45.8 billion. And again, about half of that is held in gold. However, this gold purchase program has a bit of a downside. It causes price inflation. And that's because the NBK funds its gold purchases by issuing, I think it's pronounced Tinge. It might be Tinge. It's the Kazakh currency. And so what it does in effect, it creates currency out of thin air to purchase gold from Kazakh miners. So it's kind of like the Federal Reserve's quantitative easing operations, right? The Fed prints dollars, it buys bonds and mortgage-backed securities, it holds those on its balance sheet. The difference is that the Kazakh National Bank adds gold to its balance sheet instead of bonds. And so in order to ease this inflationary pressure, this money printing that is caused by this gold buying program, the governor of the National Bank of Kazakhstan said it's going to begin selling dollars in what he called a mirroring operation related to gold purchases. So in practice, the central bank is going to sell dollars to match the amount of Kazakh currency that was created to buy the gold. So the sale of the greenbacks will serve to pull Kazakh currency out of the economy, something akin to a quantitative tightening operation. So, it appears that the National Bank of Kazakhstan is not directly aiming for de-dollarization per se, but the plan does show something very significant. It values gold as a reserve more than it does dollars. And why wouldn't they, right? Russia is their neighbor, their biggest trading partner. Of course, they're going to be wary of holding on to dollars. So if we can get rid of those dollars and help our inflation problem and get more gold, well, then why not? So that's kind of a situation that tells you that the importance of having dollars is declining. Now, we really can't talk about this de-dollarization trend without mentioning the BRICS. The BRICS economic bloc, as it rises and gains stature and power, could help usher in this multipolar world, because basically what it's doing is it's creating a competing economic bloc and kind of challenges the economic dominance of the West. As economist Peter C. Earle noted in a recent article that was published by the Daily Economy, he said member nations, and that's of BRICS, have increasingly expressed interest in reducing reliance on the U.S. dollar, exploring alternative payment systems, and strengthening trade relationships within the bloc itself. So what is BRICS? Well, it's an economic cooperation bloc, and it was originally made up of Brazil, Russia, India, China, and South Africa. Last year, the BRICS bloc expanded significantly. It added Egypt, the UAE, Iran, and Ethiopia. And Saudi Arabia has also been formally invited to join. It hadn't quite done that yet, but they're still actively involved in the bloc. Turkey, Azerbaijan, and Malaysia have formally applied to become members of BRICS. So when you look at this expanded BRICS, it has a combined population of about 3.5 billion people. The economies of the BRICS are worth about $28.5 trillion and make up roughly 28% of the global economy. And interestingly, BRICS nations account for about 42% of the global crude oil output. The BRICS also has several partner countries. These include Algeria, Nigeria, Uganda, Kazakhstan, Malaysia, Thailand, Uzbekistan, Belarus, and Bolivia. So a pretty expansive bloc. And, there's no question that some of these BRICS members would love to see the U.S. and its currency taken down a peg or two, Russia and China leading the way, right? However, there was a summit last fall in Kazan, Russia, and it revealed that it's easier to talk about de-dollarization than to actually do de-dollarization. This bloc is not yet a formidable challenge to Western economic dominance, but it has the potential, right? But they have their own internal political issues that they have to deal with, and cooperation is a long path. So again, I don't see BRICS, all of a sudden next year rising up and becoming this massive superpower, but it is there. And it is having an impact, and it can weaken the dollar status and help drive us toward this multipolar financial system that people are starting to talk about. And Earl argues that given the rising status and the economic power of BRICS, a new multipolar global financial order, quote, centered around commodity-based currencies and reduced dollar dominance is plausible. And he offers up three factors that kind of underscore this plausibility. I'll run through them real quick. First, the ongoing diversification of global reserves. Already noted it. Central banks are rapidly expanding their gold holdings. Several of the BRICS nations, including India and China, are really at the front of that push. And Earl said that this signals a shift towards commodity-backed assets and away from dollar-centric reserves. We're also seeing talk and some movement toward alternative payment systems. Russia has an alternative payment system that it's been using to kind of cope with its being blocked from SWIFT. And, the aforementioned weaponization of the dollar has helped drive the acceleration of this de-dollarization. Countries are scrambling to minimize their exposure to the greenback, as I've already explained. And as Earl pointed out, talk about the creation of a BRICS pay, which would be a challenger to SWIFT. He said this exemplifies efforts to establish financial infrastructures that bypass traditional dollar-based systems, facilitating trade in local currencies. And again, some of these already exist. China has a payment system that kind of can serve as an alternative. So these things are out there. Obviously not on the scale of BRICS at this point, but we're seeing a lot of talk. There's a lot of movement. There's a lot of will to create these alternative systems so that the U.S. and its Western allies can't use the global payment system as some kind of foreign policy billy club. And the third thing that Earl mentions is global political or geopolitical realignment. With its expansion, BRICS now includes diverse economies, right? And Earl said this indicates a collective move towards a multipolar world, challenging the unipolarity of dollar hegemony. And Earl goes on and he argues the new BRICS lineup represents a broader shift toward multipolarity. He said the inclusion of oil-rich nations such as the UAE and Iran could alter energy markets, while the growing African and Asian presence in BRICS gives the organization a stronger foothold in regions traditionally influenced by Western powers. Countries like India and China, which often compete for regional influence, must now navigate a more complex dynamic within the expanded group, balancing cooperation with national interests. So again, as I've been saying, I don't think BRICS is likely to, quote, bring down the dollar, but this new financial order could erode its status. As Earl pointed out, this has ramifications for the U.S. economy. This is what Earl wrote. A concerted move by BRICS nations to reduce reliance on the U.S. dollar in international trade could diminish the dollar's global dominance. This shift might lead to decreased demand for dollars, potentially resulting in a weaker currency. While a weaker dollar could make U.S. exports more competitive, it may also lead to higher import prices, contributing to domestic inflation. Additionally, reduced global demand for dollar-denominated assets could increase borrowing costs, impacting everything from government debt to consumer loans. So he summarizes it very well. And, as I've mentioned a couple of times, even a small decline in the dominance of the dollar could be significant to the U.S. economy. And Earl kind of touched on some of those things, but what are we really talking about here? Well, the bottom line is the global financial system runs on dollars, right? Everybody needs dollars. The world needs lots of dollars because they have to have them to facilitate trade. The U.S. depends on this global demand for dollars to underpin its bloated government. I said this earlier. The only reason the U.S. can borrow and spend and run massive budget deficits to the extent that it does is because of the dollar's role as the world reserve currency. Because this dollar dominance creates a built-in global demand for dollars and dollar-denominated assets. This absorbs the Federal Reserve's money creation and helps maintain dollar strength despite the Federal Reserve's inflationary policies, right? So the Fed has to inflate in order to facilitate the borrowing and spending. It monetizes the debt. We saw this in spades during the pandemic, right? The Federal Reserve was printing money, dumping it into the financial system and buying U.S. debt, holding that debt. And what this does in effect is it increases artificially the demand for U.S. debt, so it allows the U.S. government to borrow more at a lower interest rate. This is all predicated on people needing dollars. If people didn't need dollars and the Federal Reserve created all of these dollars, we would see massive spikes in price inflation, worse than what we've already seen after the inflationary period during the pandemic. And, I would argue that if it weren't for this global dollar demand, price inflation here in the United States would be off the charts, probably in the realm of hyperinflation. So what happens if that dollar demand drops? What happens if BRICS nations and other countries don't need as many dollars? Even in this multipolar world where dollars are still important, just not quite as important. Well, a de-dollarization of the world economy is going to cause a dollar glut. The value of the U.S. currency will further depreciate. This is exactly what Earl was talking about, a weaker dollar. And at the extreme, global de-dollarization could spark a currency crisis. You and I would feel the impact of this through more price inflation, eating away at the purchasing power of our dollars. And worst case scenario, it could lead to real, serious hyperinflation. And again, the world doesn't have to completely abandon the dollar to create these negative impacts. Even a modest drop in demand for the greenback is going to ripple through the U.S. economy. Van Eck analysts Imaru Casanova and Joe Foster recently wrote a paper or a note, and they argued that we're already seeing some of the economic tremors due to de-dollarization. And they noted that despite its continued dominance, quote, the dollar has been devaluing relative to gold, an unprecedented trend. And I think this is important because all of this really has a lot of relevance to you if you are a precious metals investor, if you are interested in gold and silver, because negativity for the dollar is positivity for the gold. As the dollar continues to weaken, we will see this reflected in an increasing price of gold and of silver as well. And you'll notice that these Van Eck analysts, they called the devaluing of the dollar relative to gold an unprecedented trend. Well, why is it unprecedented? Because it has happened during a period of relative dollar strength and in the absence of any economic crisis, right? This recent gold bull rally that started last year has broadly happened without a lot of dollar weakness. Now, imagine what's going to happen if we do start seeing significant dollar weakness driven by de-dollarization. Casanova and Foster say that the current gold bull market is being driven by an erosion in confidence in the dollar. So I'm emphasizing these two because they're basically mainstream analysts and they're confirming what I'm saying here. It's not just me. I'm not just making this up, right? So this is what they wrote. People and nations that have long used, coveted, and hoarded the U.S. dollar are now losing faith and trust in the currency as a store of wealth. And why wouldn't you, right? It's devaluing every day. This shift began in 2008 when the global financial crisis led many to question the efficacy of the banking system and Western economic hegemony. It escalated with sanctions and freezing of assets imposed on Russia by the U.S. Other countries fear that similar retribution or weaponization of the dollar is possible for lesser infractions than the hostile invasion of another country. So they basically just summed up in that paragraph exactly what I've been talking about in this show. Casanova and Foster also note that the Trump administration has weaponized tariffs. And again, we can talk about whether or not this is good policy, but it does have blowback. And They argue that it's creating resentment and further eroding the confidence that has historically underpinned the dollar. Quote, the U.S. dollar's strength against other currencies has traditionally been supported by the robustness of the U.S. economy and its reputation as one of the safest jurisdictions to invest. One thing that you can always kind of count on is investment, the movement of money, hates unpredictability. It hates volatility. And we're seeing an extreme amount of volatility right now. The VanEck analyst warned that, quote, irresponsible fiscal policies and political chaos in the U.S. suggest that one or more of the traditional drivers of gold may reemerge. As a result, the world is slowly and methodically moving away from the dollar, a shift most evident in the changes to currency reserves and increased central bank gold purchases. And irresponsible fiscal policies. What do they mean by that? Well, they're talking about the massive levels of debt, the borrowing and spending, which incidentally, the Republican-led Congress just voted to continue to facilitate. So I don't see this fiscal irresponsibility going anywhere, and I warned that it wasn't months ago. Casanova and Foster said they believe this is the beginning of a long-term trend, quote, that will become recognized as a crisis of confidence in the U.S. dollar, and that this could drive gold prices even higher than many expect. And I like their concluding line. If a digital asset like Bitcoin, created and residing within servers, can be valued at $100,000, then surely an ounce of a tangible, reliable, safe haven asset like gold could reach a small fraction of that value. And they're alluding to the fact that gold and silver are real money. They've been money for thousands of years. They will be money into the future. They're money everywhere. It doesn't matter where you go. You can go to virtually any place in the world, and somebody's going to take gold because they recognize its value. You can go through a long list of currencies that nobody wants anymore that have become defunct over the course of time. Gold is real money. So don't you want real money? Well, if you do, you can get some. Just call 800-800-1865. Talk to a Money Metals, precious metals specialist. You can talk to them today. These folks are fantastic. They're knowledgeable. They'll answer your questions. They'll help you figure out what products might work for you, how gold and silver can fit into your portfolio, your investment strategy, or even if you don't have an investment strategy, they can help you kind of develop that. I recognize that some folks don't like to talk on the phone. You don't have to. You can go to moneymetals.com and you can actually chat with one of our precious metals specialists right there online. Or if you know what you want to buy gold bars, you want to buy gold coins, whatever it is, you can actually do that right on the Money Metals website. We've got a lot of great programs as well. If you're thinking, well, I just really can't invest in gold, I don't have the money. We have a monthly purchase program that you can put in like as little as $200 a month and accumulate gold over time. So there's a lot of options out there if you want to have real money to protect your wealth from the devaluation of the dollar that to me seems pretty inevitable to one extent or another. So we're going to call that a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, sign up, get on our email list. Of course, you can subscribe to the Midweek Memo podcast on your favorite podcasting platform. And when you do, you'll be able to tune in to our Market Wrap podcast that airs every Friday, where you'll get a quick overview of the week in precious metals, along with interesting interviews and conversations between yours truly and other people from the world of gold, silver, economics, and investing. Thank you so much for listening to the show. I hope you have a fantastic rest of your week. As always, I thank you very much for taking a little time out of your day to listen to the show. I know there's plenty for you to listen to out there, so thank you for spending a little bit of time with me, and I'll be back right here again next week.